What if everything you were told about safe assets was designed to keep you calm, while the system quietly transfers wealth away from you? What if the real purpose of modern finance isn't stability, but control? Think about it. Every major financial collapse in history follows the same pattern. First comes easy money, then speculation, then debt, and finally, panic. But here's the strange part. During every collapse, the same small group of institutions somehow emerge stronger than before. Meanwhile, ordinary people lose homes, savings, pensions, and decades of work. Sound dramatic? Let's rewind to a strange moment in 1923. Germany. Hyperinflation had reached insanity. A loaf of bread that cost 250 marks in January suddenly cost 200 billion marks by November. People burned cash in fireplaces because it was cheaper than firewood. Bankers, politicians, and economists all claimed they were trying to stabilize the system. But a farmer outside Berlin made a decision that changed everything. Instead of saving money in the bank, he bought land. Meanwhile, a banker in the city trusted the financial system. He held bonds, government debt, paper assets. By the time the crisis ended, the banker was ruined. The farmer was wealthy. Now here's the uncomfortable question. If modern financial systems are so advanced, why do the same patterns keep repeating? And why do the same types of assets always survive? Before we break that down, quick question. Where are you watching from right now? Drop your country or city in the comments, because financial collapse isn't a local story anymore. It's global. And if you want the unfiltered truth about money, power, and the system behind it, make sure you subscribe. Because the deeper we go into this story, the stranger it gets. Asset number 1. Land. Let's start with the oldest asset humans have ever owned. Land. Throughout 4,000 years of recorded financial history, land has survived every monetary collapse. Empires fall. Currency die. Governments disappear. But land remains. During the Roman Empire collapse in the 5th century, the Roman currency, the denarius, became almost worthless due to debate. Silver content dropped from 95% to less than 2%. Governments printing money until the currency loses value. People losing trust in paper promises. The wealthy Romans who survived the collapse weren't the ones holding coins. They were the ones holding land. Because land produces real value. Food, resources, shelter. Even during the Great Depression of 1929, farmland eventually became one of the most stable assets. Yes! Prices crashed at first, but land still produced crops, which meant it still produced income. Compare that to stocks during the crash. The Dow Jones lost nearly 89% of its value between 1929 and 1932. Paper wealth evaporated, but land kept feeding people. This is the first rule of collapse economics. Assets tied to physical realities survive. Assets tied to promises often disappear. Asset number 2, gold. Gold has been called money for over 5,000 years. And yet, every modern financial system treats it like a relic. Why? Because gold exposes the weakness of paper money. Let's look at another historical moment. 1971, the United States quietly abandoned the gold standard. Before that moment, foreign governments could exchange dollars for gold at $35 per ounce. But the U.S. had printed far more dollars than it had gold. So President Nixon ended the system. Overnight, this is called the Nixon shock. A government changing the rules during a financial crisis. After the gold standard ended, something interesting happened. Gold exploded. From $35 per ounce in 1971 to over $800 by 1980. That's more than 2,000% growth. Why? Because when trust in currency falls, people move to something that cannot be printed. Gold. Even during the 2008 financial crisis, gold rose from roughly $700 to nearly $1,900 per ounce within a few years. Again, the same pattern. Collapse. Panic. Flight to hard assets. Asset number 3. Businesses with pricing power. Now here's something most people overlook. Certain businesses actually thrive during economic collapse, but only if they have one critical ability: pricing power. That means they can raise prices without losing customers. For example, food companies, energy companies, utilities. Look at the inflation period of the 1970s. While the average consumer struggled with rising prices, some companies saw profits explode because inflation allowed them to charge more. Meanwhile, workers' wages lagged behind. Sound familiar? Today we see similar dynamics. Large corporations raising prices faster than costs. Record profits. Record inflation. This isn't coincidence. Businesses with pricing power can pass inflation to customers, which means they protect their margins. In collapse economics, that's survival. Asset number 4, foreign currency. When a national currency collapses, people often turn to foreign money. During the Argentine financial crisis of 2001, the peso collapsed. Banks froze, citizens couldn't access their savings, but those holding US dollars were protected. The same happened in Venezuela during the 2010s hyperinflation. The bolivar became nearly worthless, but dollars became the unofficial currency. Street vendors, landlords, even taxi drivers began accepting dollars. Why? Because foreign currency acts like an escape hatch. When trust in one monetary system collapses, people migrate to another. But here's the problem. In a global crisis, every currency could weaken simultaneously, which leads to the next asset. Asset number 5, real estate. Real estate often behaves differently than land because it's tied to debt, and debt behaves strangely during collapse. During inflationary crises, fixed-rate debt becomes easier to repay. If inflation rises 10% per year, but your mortgage stays fixed, the real value of that debt shrinks, which means borrowers benefit, but lenders suffer. This is exactly what happened during the post-World War II inflation period. Governments inflated away massive war debts. Sound familiar? Today, global debt sits around $307 trillion. Yes, trillion! That's more than 3 times global GDP. Which means inflation becomes politically convenient. It silently reduces debt. And real estate owners often benefit. Asset number 6, the one nobody talks about. Now here's the strange one. The asset that survives collapse the most is knowledge. More specifically, skills that produce value in any economy. Doctors, engineers, builders, farmers. During the Soviet Union collapse in 1991, millions lost savings overnight. But people with useful skills rebuilt quickly, because skills cannot be devalued by inflation. They cannot be confiscated by banks, and they cannot be printed by governments. Which brings us to the bigger question. Why do financial collapses follow the same patterns again and again? The answer lies in a mechanism most people have never heard of. The 4,000-year pattern. For 4 millennia, financial systems have followed the same cycle. 1. Credit expansion. 2. Asset bubbles. 3. Debt overload. 4. Collapse. 5. Reset ancient Babylon. The Roman Empire. Medieval Europe. The Great Depression. The 2008 financial crisis. Different centuries. Same pattern. But modern finance added something new. Something powerful. And dangerously opaque. Why safe assets fail? The modern financial system is no longer built on simple banking. It's built on something far more complex. Derivatives. These are financial contracts whose value depends on other assets. Sounds harmless, but here's the scale. The global derivatives market is estimated to exceed $600 trillion in notional value. Let that number sink in. 600 trillion! That's nearly 7 times the size of the entire global economy. And most of these trades happen in the shadows, outside public exchanges, between massive financial institutions. This is called the shadow banking system. Now, here's where things get interesting. During the 2008 financial crisis, derivatives tied to mortgage debt triggered the collapse. Specifically, mortgage-backed securities. Banks packaged risky loans into complex financial products, then sold them as safe investments. Sound familiar? Ratings agencies approved them. Governments ignored them. Investors trusted them. Until the system snapped. But the most shocking part isn't the crash. It's what happened next. Because behind the scenes, a tiny group of institutions controlled the plumbing of the entire system, and the name behind that system. You won't believe it. Here's a final warning. Because we are on borrowed time. The uncomfortable truth is that our modern financial system is faster, more complex, and more interconnected than any system in history. This means the next collapse won't unfold slowly. It will move at digital speed, driven by algorithms and high-frequency trading. In the past, crises took years to develop. Today, they can happen in days or even hours. But the real danger isn't the collapse itself. It's denial. Every generation believes its system is different, more advanced, more stable. The Roman Empire thought its financial system was permanent. So did the British Empire. And so did Wall Street before 2008. History repeats, not because people are foolish, but because systems built on borrowed time always look stable until they suddenly aren't. So the question isn't whether another collapse will happen. The real question is, will we recognize the pattern before it's too late? Or will we trust the same institutions that created the last crisis to save us? Are we wiser now? Or just walking the same path in better suits? If this made you think, share your thoughts below and subscribe.